Okay, in this video we're going to be discussing a concept that I know a lot of people struggle with and don't like, the terms of trade. And the terms of trade is both a demand and a supply side factor impacting growth, but just like the exchange rate, it's mainly going to impact aggregate demand. So the terms of trade is a ratio of Australia's export prices to import prices. Okay? It has nothing to do with the volume of exports that we're selling. It has nothing to do with the total value, although the total value will generally increase when we have higher prices of our exports. But we might be selling one export at, say, a price of $500 and importing 1 million imports at $2 each. Our terms of trade would be higher because the export price is a lot higher than the import price. So the terms of trade is just an index which measures the average price of exports divided by the average price of imports. And it uses an index, so it's an indexed figure. If the terms of trade increases, there must be a rise in the average price received for Australian exports relative to the price of imports. So basically what we could say is that it could increase because export prices increase, it could increase because import prices decrease, it could increase because export prices go down but not as much as import prices, or it could increase because export prices and import prices go up but export prices go up by more. So as long as the numerator is higher than the denominator, compared to what it was last year, the terms of trade will go up. When the terms of trade is high, it basically means that we can purchase more imports for any given volume of exports. Because we're getting a higher price, for any volume of exports we can now purchase more imports. So what I mean by that is, let's take this boat full of iron ore and this plasma TV. In the year 2000, one ship was probably equivalent, the price that we were getting for this ton, so the total value that we would get from selling this total ship of iron ore was equivalent to about 2,200 plasma TVs. So they may have been selling for, say, $2,000 each, and therefore the total amount on this ship was equivalent to 2,000 times 2,200 plasma TVs. So whatever that is, 400,000 or something worth of money. Now, because the one ship is equivalent to about 22,000 plasma TVs, because this ship in 2012 was basically worth 5 times what it was in 2000, assuming it had the same amount of iron ore because the price was so much higher, and the price of plasma TVs had dropped from about $2,000 to $400. So basically what we're saying is it's a measure of the average price of exports compared to the average price of imports. And what we're saying is that if export prices are higher, we can with the money that we're getting from any given volume of exports, we can buy more imports, essentially. So the terms of trade will generally increase due to higher demand for our exports. So if China demanding more of our commodities, like they did in 2012, that caused the price to go up from $30 a tonne to $150 a tonne for iron ore, and therefore that led to a higher terms of trade. Very important that prices are determined on world markets for a lot of these things. So basically, the price of something like iron ore is the same for everyone around the world. So don't be the person that says that higher terms of trade is bad because nobody wants to buy our exports. So if the price of iron ore went from $20 to $100, if you start saying, well, this is bad for Australia because nobody's going to want our exports and commodity prices are too high and there'll be less demand, that is not true. The price is only high because of higher demand. And the price is going up everywhere, so it's not like they're not going to want our commodities anymore because they're going to be expensive wherever they buy them from. So a higher terms of trade is good for aggregate demand, it's good for our economy, it's good to have expensive exports because it means we're generating more income. So the terms of trade's impact on aggregate demand is the most important thing. Basically it means we're receiving a greater income per sale of exports and therefore there's more money coming into our economy. However, because there's no increase in the quantity, the terms of trade increases does not directly impact on real GDP. So what I mean by that is the actual increase in price is not going to be directly reflected in X because the quantity hasn't changed. So the volume sold has not increased, so the value of X will actually stay the same. That doesn't mean that aggregate demand stays the same because other components of aggregate demand are going to increase. So the impact on aggregate demand and real GDP is actually going to be through investment and consumption. Because when we have higher export prices, firstly, businesses are going to be investing through the roof because they know what they're selling is now worth 5 times as much. They're going to have high confidence, they're going to want to expand their productive capacity because they know that what they're selling is worth so much and they're going to make so much money out of it. Consumption expenditure as well is likely to rise because anybody related to these industries is going to be earning a higher wage. Okay? That's what happened when the price of iron ore went up, is that all our miners, our engineers, our surveyors got a higher relative wage, resources flew to that industry, and that led to increased consumption expenditure because people were earning so much more. So the increase in aggregate demand from the terms of trade is through investment and consumption spending. There's also a multiplier effect to other industries, because when the miners and engineers and surveyors all have more money, they spend more money in local hotels, in local bars. Remember that video we watched where the investor made a lot of money through her housing prices going up, so she would spend more. Jewelry stores make more money because all these miners and people related to that industry have more money. So higher terms of trade lead to increased investment, increased consumption, and higher aggregate demand. The impact on supply is a little bit more harder to understand, but basically most Australian imports have an inelastic demand, so we're going to buy them even if the price is quite, regardless of the price. So when the terms of trade increases, that may be due to cheaper imports, and because we have a lower price, it will lead to lower costs of production for businesses and boost aggregate supply. So if the terms of trade goes up because of lower imports, it will lead to lower production costs, an increase in the incentive to supply, and an increase in productive capacity. So a higher terms of trade, if it's due to lower import prices, will shift the supply curve to the right. In Australia recently, the higher terms of trade was due to purely based on higher export prices, so it was more of a demand side factor. You also need to be able to go the other way, and that's what's most important with what's going on at the moment. So at the moment, the terms of trade is going down. You've got to be able to explain the negative impact that's having on investment and consumption because of lower profits, lower incomes, and the multiplier effect, and link it to negative impacts for aggregate demand. Don't really need to talk about supply because import prices aren't really going up. That's not what's causing the terms of trade to go down. So in recent terms, the terms of trade stimulated our growth until 2011 because of strong growth in China and India. Recently, the terms of trade has fallen, mainly due to large supplies of commodities like iron ore, and this has reduced incomes for many export industries, decreasing investment and decreasing consumption expenditure. We're still exporting a lot, but that's not reflected in the terms of trade. So Australia is starting to shift away from purely mining-led growth because we're not getting the incomes that we once were. The only good thing about the lower terms of trade is that it's lowering the dollar, and therefore it's making other industries more competitive, like manufacturing, although they're kind of dead, education and tourism. Okay. So the mining boom appreciated the dollar significantly, and this had negative impacts on the sort of east side of our economy. But now that the dollar has fallen to approximately 77 US cents, that's stimulating growth in other areas. And there's a summary of the table of effects. Okay, I'll go through this more in detail in class, but you can see the impacts of each four things and their impacts on both demand and supply.